Welcome to another episode of the Financial Frontier. I'm your host, Patrick Camuso. Very excited for today's episode. A lot of headlines and new regulatory topics to cover. As usual, nowadays this space moves very quickly. So let's get right into it. I'm going to share my screen for the video viewers, for the people that are just listening on audio only. I will be describing everything that we go over. So stay tuned in. But if you're watching on video, you can also look at some of these news topics that we're going to hit on. So bear with me here one moment. Share screen. There we go. Okay. So the first topic today is out of Yahoo. U.S. lawmakers urge the IRS Treasury to hurry on crypto tax rules. So, we're seeing regulators and, the political side of this continue to focus on crypto and continue to urge for more tax clarity and tax rules around crypto. So the U.S. Treasury Department and IRS should promptly release planned crypto tax rules so industry can be brought to full compliance, Reps. Brad Sherman and Stephen Lynch said in a Monday letter. For many years, the cryptocurrency industry has been a major source of tax evasion and a significant part of the nation's tax gap. This is a large reason why, there's such a focus on crypto is because of the level of non-compliance that people believe is present. And it's starting to become a political focus. If you go on the IRS's website right now, they'll claim that there's a 75% non-compliance rate based off of data that they're collecting from exchanges and other sources related to taxpayers. So they're saying 3 out of 4 people are not filing their taxes right now with crypto. This letter was noting more just about the fact that the proposed broker regulations are still not yet fully implemented, and they're still reviewing the comments that came from the comment period. We still don't have a final form of the 1099. So we'll see where this goes, but this just highlighting that there's going to be a continued focus on cryptocurrency taxes here, politically speaking. And I think this article also speaks to the regulatory environment, and this is something that I've been trying to highlight through a series of headlines, and this sort of wraps it up into one story here. Roger Ver faces 30 years, CZ jailed, signaling new era of enforcement, ex-Biden advisor warns. And there's even more that you can add to this headline because we've seen the indictment of Frank Algren III, which is the first tax-only case related to crypto invasion, and an indictment from the Justice Department, among others. So I would agree with this article. We are in a new era of enforcement. So this goes on to say, recent legal actions from the DOJ signal intensified scrutiny and a new phase of enforcement in the crypto industry. Investors are likely to shift towards asset-backed and regulated cryptos as they offer greater transparency and security. I don't know if I necessarily agree with that, but we're definitely entering a new age of enforcement. And when you're dealing with cryptos that are taxed as property, there is a higher burden on you as the taxpayer to properly do your accounting and report your taxes. The need for proactive regulation in the crypto sector can help balance innovation with investor protection. The IRS plays a key role in enforcing crypto tax guidance. So, this is going to go on to highlight a lot of these stories, which we've already covered. And the fact that, when you put this all together, we're looking at a new era of enforcement that's going to get much more strict. And, people that are being non-compliant are going to get ensnared in this. Here's a quote. I still believe that the mere fact that he was indicted and sentenced, and they're talking about Roger Ver, is a reminder to the cryptocurrency sector that in spite of the lack of regulatory parameters for this sector, nefarious and questionable behavior will not be tolerated. And, this is a great point. Like, maybe there is some regulatory ambiguity around some of your transactions or how certain protocols you're using are going to get taxed. But that ambiguity generally doesn't work to your advantage as a taxpayer, because the IRS can start to come after you for some of these tax issues several years later, and in some cases, your statute of limitations can get extended indefinitely. So you are liable for the positions you take on your tax return. So to the degree that there is regulatory ambiguity, you want to make sure that you're taking a well thought out tax position in that you work on with the tax advisor, and that you document appropriately. And usually, with lack of guidance, you're going to have to take a conservative approach wherever there is that gray area to protect yourself from issues like this. So, here's another quote: regulations are created to protect, prevent, empower, or should be created for those reasons. Crypto is still a new frontier, hence the name of our podcast, The Financial Frontier, and I believe it is here to stay and will grow in prevalence and utilization. The federal government has no choice but to establish a regulation environment that will protect investors and so on. So again, we're seeing not only political talk, but we're seeing action from the DOJ that is in line with the fact that the regulatory environment and the tax enforcement is continuing to heat up in this space. So, if you're speaking with clients or potential clients that aren't fully compliant, now is the time to get into compliance. Another recent example of tax enforcement: Bitcoin billionaire Michael Saylor to pay DC $40 million in tax fraud settlement. Michael Saylor, co-founder and who we're all familiar with, of the software firm MicroStrategies, allegedly avoided paying taxes in the city over 15 years by claiming residence in Florida over Washington. So this isn't an example of the federal government coming after non-compliance in the crypto space. This is actually an example of, the state revenue agencies coming after Michael Saylor for basically claiming that he's living in the wrong place. So this suit, you may remember, was brought back in April 21. So, that's another thing. You can see how long these processes take. Michael Saylor's net worth is quoted at 4.6 billion. That's up there. So, basically, they're saying that he allegedly engaged in a scheme to claim residency in Florida and avoid paying income taxes in Washington since 2005. This is another thing that people like to do on social media and crypto. They say that Saylor openly bragged about the tax evasion scheme. Never a good idea. It's never going to help you when you're sitting in tax court. Encouraging his friends to follow the example and contending that anyone who paid taxes was stupid. So I guess, the DC courts got the last laugh on that one. So the suit was brought in DC Superior Court under Washington's False Claims Act, which was the first of its kind under recent amendments expanding the Attorney General's enforcement authority. So this is a new program where, whistleblowers who find someone doing this, if they report them, they can get up to 25% of the funds of a successful suit. So the complaint was originally brought onto Saylor by Tribunium LLC, which is a tax service. So they seem to have reported him, and they're actually going to get a share of the 50 million. So the IRS and most state tax agencies, they will have whistleblower programs where if someone's aware of your tax evasion, they can report you and basically get a referral fee for it. So that's another thing. If you're out here not accurately filing your taxes, it's not wise to brag about it like Michael Saylor did. Another interesting headline: FTX settles the $24 billion tax dispute with the IRS for a much lower figure. So the settlement includes FTX paying $200 million within 60 days of court approval, and then $685 million after compensating other creditors and customers. So if you recall, we've covered this issue with the IRS and FTX before. Initially, they were claiming this was a $44 billion tax bill that they were disputing. and that was amended down to 24 billion, and now it was negotiated down to the payments we just mentioned. Um, So the settlement provides much needed certainty for FTX's creditors and customers in the recovery process. So now, since they've resolved this, they're saying FTX can now focus on implementing its reorganization plan and actually distributing the assets to its stakeholders. And now, there's not going to be prolonged litigation, which would further complicate the bankruptcy. Part of the argument that FTX made was that it had a lot of valid deductions, but the IRS was not allowing them, was disallowing them due to documentation issues, which is something to keep in mind. If you're running a business related to crypto, even if you have ordinary and necessary business expenses, under the audit process, these can be disallowed if we don't have supporting documents to substantiate this. So this is interesting, to see this settle. This is a long time coming. I know a lot of people are going to be happy to see this taking another step forward in the right direction to actually having some sort of resolution. The next headline, you may have seen that the Trump campaign is starting to take cryptocurrency donations. I think this is interesting because, once this article came out, or once this headline came out and this news came out, I was starting to get tax questions related to it. And the question is basically, if you go ahead and you make a political donation with cryptocurrency, are there tax implications to that? Is that going to be a taxable event? The short answer would be yes, because if you go ahead and you donate a cryptocurrency to the campaign, you're disposing of that cryptocurrency. This isn't some type of charitable contribution. So yes, you will be taxed on that. And what will the tax be? That's going to depend on your cost basis, your holding period, and your accounting method selection. But you are going to be taxed on that. You are going to have to keep track of it for accounting purposes as well. So, keep this in mind. If you are out there making political donations, make sure you're tracking this for accounting purposes appropriately and applying the right tax treatment to it. And then make sure that you're reporting this appropriately for tax purposes as well, related to the disposition. So more tax enforcement that we're seeing abroad. Canada schemes to launch audits against Bitcoin tax evaders is the headline out of Yahoo. So the CRA, which is the Canada Revenue Agency, is reportedly targeting Bitcoin investors as well as other crypto users in federal tax audits. The CRA has also sent out questionnaires to determine the previous trading and investing activity. While many investors so this says, with many investors using KYC enabled exchanges to store ID and trading history, it's likely that audits will uncover past trading history as well. So we're apparently going to see much more audits out of Canada. And similar to what we're seeing, the main focus here in the US among other states and among other countries is the focus on non-reporters, because right now that is the biggest tax issue, is the level of non-compliance. And a lot of this data revenue agencies have, whether we're talking about the IRS, the CRA, or other revenue agencies. These revenue agencies also have data sharing agreements in many cases where, information that the IRS may get shared with the CRA or the ATO and vice versa. So there's going to be a bigger push towards people that are not reporting. And as this article states, usually what we see is that, people have if they haven't been on top of their crypto taxes, they have several years to report. So all of that data is on public immutable blockchains, and this is going to be the first of many pushes that we see from revenue agencies that are going to target people that haven't been filing, and make a push for them to file. So keep an eye out on this, and also expect to see more of this in Canada, in the US, as well in other countries abroad. So this is a interesting case that I do believe is going to have some impact on the cryptocurrency industry and the NFT industry. So Tax Group backs Amazon and South Carolina sales row. So there is an issue with 3 months of fulfilled by Amazon sales in 2016, where Amazon was acting as a marketplace facilitator, where they did not properly collect their sales tax liabilities. What we're seeing is now South Carolina is coming after Amazon for the uncollected sales taxes, and they want to collect the past sales taxes and apply this retroactively. So that's what has found that's what has created this course in this court case in the South Carolina Supreme Court. So the ruling leaves Amazon holding a $12.5 million tax bill on past sales and could expose, this is how it's going to factor into crypto potentially, is it could expose other taxpayers to retroactive taxability. Because what this court case is doing, it's setting precedent that sales taxes can be applied retroactively. And as you know from the book that I've written, Navigating the NFT Sales Tax Maze, Wayfair 2.0 for Web 3.0, I believe that this is a huge risk, the retroactive sales taxes for NFT sellers and people transacting in digital assets, because many NFTs, as this book will outline, are taxed as digital products and goods in many states and are going to have a sales tax exposure. And to the degree that marketplaces and individual sellers have not been properly collecting and remitting this, they're exposed to this same risk related to retroactive tax applicability related to uncollected sales tax liabilities. So South Carolina, as this article goes on to say, South Carolina would be an outlier if the Court of Appeals decision is allowed to stand, because it would impose a marketplace collection obligation retroactively prior to the state legislators enacting a law. So, we'll see where this court case goes, but obviously not collecting sales taxes can create huge issues. Just the fact that they're in law in the Supreme Court with South Carolina is an issue. And it's starting to become clear that, retroactive tax applicability related to sales taxes is something that is going to be imposed in many states. And if you're out there selling NFTs, or if you've created a marketplace and you're facilitating the sale of NFTs, you need to get bought into compliance. And you don't want to be risking your bottom line when these states do come after these sales taxes. It is going to hurt your company's bottom line if you didn't collect these and you have to come out of pocket for these. So I also want to point out that last week I was at Consensus, and if you follow me on LinkedIn or Twitter, you may have seen me. I've made several posts on the topic. So I encourage you to go check out my profile and read some of the posts. I've posted my takeaways, some of the things that I've seen at the conference. It was great. It was extremely high energy. Everyone was very positive. And, I don't make it out personally to many of these conferences. So it was great to be there because you meet a ton of great people, new faces that are open to networking. Also, we get to, meet face to face and shake hands with a ton of people that I only know from being online on LinkedIn and Twitter and doing Zoom meetings with them. So getting the opportunity to meet them as well was fantastic. I also got to connect with a ton of clients that I've had for, at the firm a long time. We got to connect in person. Also met some new potential clients. So I encourage you, to take the time and effort to go to these conferences because it is beneficial. And you also get a lot that you get to see and learn about the space and sort of get a pulse on where our industry's at. And, one key is that the industry is still evolving fast. There's tons of new companies and new use cases and ways to leverage this technology to promote more decentralization and new business models. So that was one thing that we've seen is, a lot of the new startups and companies that were in the space, we got a firsthand glimpse at them and, what they're doing in the space. Another big and interesting notable point is that, institutions are here, they're getting involved, and they were all over this conference. So we're starting to see more maturity in the space, and a lot of institutions come in, which is great to see. Being in the space a long time, this is something that we've waited for years. So I already said, the community is amazing. At Consensus, it was a great experience in that regard. But one of the other most notable things about the conference is that the regulatory environment is taking center stage. There were several talks related to regulations, whether we're talking on the legal side or also on the tax and accounting side. So this is quickly becoming the forefront of our industry and an extremely large consideration versus some afterthought like we've seen years and years ago. So I think that's another sign that the industry is maturing, but it's a sign for you as a Web3 business or an investor to make sure that this is top of mind for you as well, and that your legal, accounting, and taxes are in order and that you're in compliance, because the space is only going to keep maturing. We're only going to continue to see more regulatory focus from the industry and from regulators and enforcement arms. So, this is something that you want to understand and make sure that you're on the right side of all this. So, again, Consensus was great. If you want to see more of a video summary on this, go and check out my social media. I have tons of posts. I was making posts every day to try to give brief summaries of, what was going on there. Lastly, I would encourage you again to go to Amazon.com and type the book Navigating NFT Sales Tax Maze, Wayfair 2.0 for Web 3.0 into Amazon and get your copy today. This is an emerging tax issue in our industry that's currently going overlooked by most industry participants and tax professionals. And it's creating a huge tax risk for anyone that's transacting in cryptocurrency or selling NFTs or digital assets. This book lays out everything that you need to know, the risks, the solutions, and will give you a general overview on where the regulations are related to NFTs and sales taxes and digital assets right now. So get your copy today on Amazon.com, Navigating the NFT Sales Tax Maze. And lastly, I would encourage everyone to visit our website at camusocpa.com. This is where you're going to want to go if you want to schedule a consultation with me. You can go right to this Contact Us page, and we can schedule a time to sit down one-on-one and discuss your business or your portfolio. I'll also draw your attention to our Web3 newsletter. You can sign up for this newsletter on our website, on Substack, or on LinkedIn, and we will deliver timely tax, accounting, and regulatory news directly to your inbox so you can stay up to date on all these developments. And outside of the newsletter, check out our blog section. We're constantly putting out new blogs with detailed, comprehensive information on a wide range of tax and accounting topics related to digital assets. So, those were most of the items that I wanted to cover today. There's much more that I didn't get to that's just out of the scope of this video that will be in the next newsletter edition of our Digital Asset Digest. So definitely go and check that out. Otherwise, I hope that you took some valuable information from today's episode. And until next time, I'm your host, Patrick Cambuso, signing off.